Willem, Fed says 3 hikes. Job market data continues to come in well. Patrick Harker talking up the possibility of a March hike. What's your call?
I think that 2 are more likely than 3. Basically, while it's possible to interpret the robust payroll growth and the rather modest earnings growth as evidence there's still a lot of slack, which is, I think, my underlying view. There's still significant slack. There is an alternative view that says what it actually represents is simply a continuation of the decline in labor share. Right? Mm-hmm. That means that the price markup on earnings is rising. So price inflation could actually be, in an underlying sense, higher than wage inflation because it's this continuation of the erosion of labor share and national income. And I see actually no fundamental forces to reverse that because automation is proceeding apace and globalization hasn't been reversed in a meaningful way yet. So I'm sort of a bit stuck between them, but my bet is 2.
It's like a coin cost, basically. It feels like what you're saying. Mike, the BOE bought itself a little bit of time by lowering its NAREU estimate to 4.5%, right? The Fed hasn't been able to buy itself any more time. How do they continue to do that when they don't know what the policy is going to be? Like, how do they even pretend to model their growth forecast?
Well, they're not pretending to model it. They're basically saying in December, and this is an important point, in December they said, based on the forecast that we see going forward from this point, it would call for 3 rate increases by the end of 2017. And that's always a disadvantage because we go back and say, well, the Fed is calling for 3 rate increases. Well, I don't know, Willem, what your call was on December 15th, but it may have changed based on the circumstances. So they don't get to continuously update as the markets do. But what they have been doing, and you mentioned Patrick Harker, John Williams last Friday, and we're going to hear from Jim Bullard today, Charlie Evans later today. They're trying to keep their options open. They don't want the markets locked into saying, they're going to raise at a certain month at a certain time. They want people to at least have the possibility in their minds that they could raise in March. And that you can make the case that if you deserved a rate increase in December, nothing's really changed. If you think the rate's too low, you could go in March. So let's keep that as a live option. We have a news conference. We can do it then, because in the past they've been criticized for missing opportunities. Mm-hmm. So if we see inflation go up a little bit and the labor market continues strong, then maybe in March they want to take that option.
So, Phil, if you think there are 2 for this year, how many would there have been if Hillary Clinton had been elected?
2.
Exactly. So there's no variation at all. So at this point, what we're projecting in is exactly what would have happened without Donald Trump.
3 would have been slightly more likely under Hillary, I think, because the anticipation of the future fiscal stimulus has strengthened the currency, which is disinflationary, and the deregulation, at least for this year, provides a positive supply shock, which is output positive but inflation negative. So on balance, because of this combination of a stronger currency than would have been the case under Hillary and the deregulation, I would actually see slightly lower inflationary pressures in the US for this year. Once the fiscal kicks in next year, we'll get significantly higher inflation.
The Fed has to react to markets. And what's going to be interesting is February 28th, we're supposed to hear from Donald Trump. Well, you're right. They don't have to react to markets, but they look at what's going on in markets. And Donald Trump is going to release, in theory, some sort of budget proposal, some sort of idea of what he's going to do on the fiscal side, February 28th. The Fed comes in on March 15th, and you're going to have some sort of market reaction to the possibility of deficit spending. Greg Valle of Horizon Investments out this morning saying it looks like Trump is going to propose a big deficit. He's going to say, we'll spend, we'll try to cut, but we're not going to cut enough to make up for it. So if the markets are sending yields higher because they think we're going to see big deficits, then what does the Fed do? Do they ratify that, or do they risk falling farther behind?
Willem, just to drill down on that, do you think the Fed is outsourcing monetary policy to the market to some extent?
It has done so for years, right? The Fed of all leading central banks is the most oversensitive to sort of high-frequency market indications, be it financial conditions or volatility. And clearly, if you have to respond to how you expect the economy will evolve, and that includes the response to the market. But you should not really be taken by the hand by the market and led wherever the market wants you to go for fear of disappointing the market. Occasionally, a disappointment for the market when the market's got it plain wrong is appropriate. I think actually if there were to be a larger than expected fiscal stimulus, and I haven't actually heard anything yet, for instance, on the infrastructure side at all, other than the Great Wall, right? Then I think the Fed would, for fundamental reasons, want to do more.